Hi, action junkies. I mean traders. How's everyone doing today? Hello, Rena, Hugo, Kevin, Eric. Welcome to Face. Looking forward to interviewing you in 30 minutes. A first time interview from Eric Bezmajian at the bottom of the hour. Hello, Rena. Let's take a look around. Sinatra, how's it going? So I wanted to start with this, and I like when things take a long time to develop. But I've been pounding the table that I didn't think we'd have any big break in crude until the 62 bears were shaken out. Who remembers that? So it was my contention, all these hits at 62 and all the stops piling up above 62 and also with risk on. I think I said it's going to be interesting to see where crude is. Blake, when the S&P's top, and to me, it was just giving people too many opportunities to short it at the 62 level and without much satisfaction. They could have taken it and played the range. Well, we've taken out all the stops here. And a lot of people are saying this is a breakout out of a formation. They're looking for new highs. That's not my contention. I'm looking for a lower high. So is it going to be here? I put on a little piece here. Is it going to be up to 65? So a lot of people are looking at this whole formation, forecasting a new high in the 70s. Maybe they'll be right, but it's my belief that this was just the first part of the break, and this is still a correction. When you look at this, it's about $6 back after a $10 break. These are big round numbers, right? So if we had equality from here, it would take it down towards the 53 level. An area that Tracy Schuchart was looking for to be a buyer. She was looking for, 52, 53 when I was interviewing her here. After this initial big break, she said she'd be a buyer here. So we'll see what happens. There aren't as many bears left as there were. There were probably tons of bears, and this candle elected most stops. Okay, because it didn't just take out this high by a little bit, took it out by $1 or so. So shorts had their head squeezed, so their eyeballs were popping out. And now I'm looking and stalking, even have a small piece on here in energy. Everyone clear on my views in energy that I'm not looking for a new high. We did have divergence at this high on the daily time frame and other time frames as well. So this could be a failing rally. I don't know how much more the stock indexes have in it. We've surpassed one of the fib levels. I remember that Peter Goodburn, and you guys think I do the interviews just for you, don't you? That I'm some kind of humanitarian. But I get to find out what people whose work I respect. I bring in. I pay attention, just like I pay attention to the team when they're talking about their outlooks of market structure. So, if we're already above the 41.47, but there's a little plus or minus 1% on there. And then I remember Peter had another sell zone up around, I believe, 41.78-ish, something like that. So, could carry. But one thing I have to say, tell me this doesn't look like two different markets. All right, so here's the 2-hour S&P. Okay, you could probably see it even better here. Okay, so you had this break here, and look at NASDAQ. All right, so the S&Ps again are pressing new all-time highs. I think there's a possibility, even if the S&Ps rally another 20 handles, that may have been it in NASDAQ. I mean, to me, it looks like it may have been a key reversal, right? We engulfed the previous day's range. Okay. So, you could look for a spot to sell it, be wrong over the high of the move in NASDAQ, which I think is another 80 handles from here. And maybe it has some problems right in here. on this bounce. So this looked pretty impulsive to me. So I think it's going to be a challenge for NASDAQ to make a new high. NASDAQ's the preferred short, right? It took forever for it to make new highs. Just did it this week, you know? Took forever for it to complete new highs while S&Ps were recording new highs for days and days and days prior to the NASDAQ being able to accomplish it. So it's my contention that since the COVID crash, the NASDAQ led the way up, and I believe it will lead the way down. It's going to have a bigger percentage loss when we get this correction than the S&Ps and the Dow, and that's most likely because even during the Dow downtime, people will still be trying to buy cyclicals, materials, the reflation trade rather than a growth like FANG. Okay, so that's the way that looks to me. Anything else I want to? Oh yeah, Canada finally flushed the bulls out under the 50% level. Right, held it here, and almost got to the 61.8. So I'm pretty close to pulling the trigger on Canada because if we're going to get a crude top, and I also don't think we're far from another dollar rally, right? It's trying here today, has some work to do. And even if Euro's going to 120, there's some real nice confluence here. See that cross where the two moving averages cross on the 4 hour. So I'm short, and that'll be a take profit day. Okay, thank you, Sanse. So any questions for me on anything I've covered? Yes, I do. I don't know why everyone's always asking me what I'm doing in my account. What counts is what you're doing in your own, right? I have multiple positions on Tom. So, you know, I don't know. I mean, here we are back at 1750. So we'll see. Maybe this was the bottom in silver. Silver is acting better than gold. I thought we had turned it back from the 1750. I start getting skeptical if it's going to give me too many chances to sell it here. So I'm neutral on the metals. It's an IDK for me. Accumulate it. Buy time. Buy time. I saw there was a huge option trade. I saw it came across Reuters that someone made, I don't know how many millions of dollar bet that the VIX would be over 40 by the July expiration. So that was kind of like, I don't know, 20 million, 10 million. They did, some type of vertical bull, but it was a bullish strategy looking for over 40. Okay, that helped? Yeah. Um, so I think that's about it that I want to cover. Can I say, uh, you know what, Tom? Anything and everything can happen in the business. So I'll say yes. Nothing's impossible. And Bitcoin, Blake kind of talked about it. Maybe we'd get to sell the event on the Coinbase IPO. And you have a trigger here, right? So you had a couple of down days. Wasn't a big down day, but kind of fading with some follow through here. Take a picture. That's a third drive. I'm not saying that we can't rally again. But the RSI was never blown out over 70. Pretty classic looking formation. I guess you could say it's okay until it takes out 56. But I wouldn't be long up here. All right. So before the 3 drive manifested, it was here, and we needed to take out this high first, and we did. And then he had that big event with Coinbase and all those guys with an online exchange becoming multi-billionaires, and Bitcoin faded a bit. So time will tell there too. Stepping level stones. Sanse is a very hard-working trader, I could tell. So good morning to you, Blake. How are you?
Hey, we're at highs. Life is good.
We're at highs
We're at
in the
highs, all-time
S&Ps.
highs in the stock market. Why not?
Uh,
It's another
oh yeah.
rainbow and unicorn day in the stock market. So we've got that going. So
Okay.
let me tell you, somebody had asked you what you were doing trading,
Yeah.
but I'll share with you like a trade I did overnight or over the last 24 hours. Let's do that. Okay. Now, let me also explain that if you're in our ForexAnalytix chat room, that's where we're always talking about what trades we're doing, what we're thinking. Like, I'll just give you an example. Oh, you know what? Hold on 1 second. I got to do something really quick. I just got triggered. Okay, so let me just show you. This is our chat room from this morning. So this was about an hour ago, less an hour. Wait, hold on. 30 minutes ago, maybe. Hold on. This is our chat room, so you guys can kind of see what is all happening this morning. Oh, I think I just skipped it. Hold on. Let me get to it. And by the way, if you guys are watching live via YouTube, give us a thumbs up, will you? That'd be really, really awesome. I'd appreciate that. Just because it helps because we use a service called Restream, which, okay, here we go. Anyway, it does help us. So I appreciate that. Aussie dollar hit the 50% retracement at this level and this level at 77.60 may end up holding the S&P. It's back at key resistance as the S&P is back at key resistance at the 4150 level. And then where's the chart? Did I not post a chart? I did post a chart. Oh, it's right here. I posted it above it. So I said, S&P's at highs. Aussie's struggling at the 50%. So if it gets back to 77.50, I'm going to sell some. Guess what just happened just a moment ago? We traded up to it and I sold some right there. So, that if you want to know what I'm doing, I'm telling you, because this is a good risk reward for a short, especially if you're dealing with a nice squeeze over the last couple of days. I still think we're building a head and shoulder pattern. I think between 77.60 and 78, probably, these areas right in this zone will offer you areas to be on the short side. And we could go a little higher today too. I'm not going to put my stop right at the 50% retracement above these highs. I don't want to do that because I still think with stocks as strong as they are, it's entirely possible that we move up towards, the 618, especially like, Dale, let's think about that. How many people sold the S&P 2 days ago? Do you think?
I don't know. I did it yesterday. It worked, but a day trade. A
Yeah,
couple
yeah.
of days
Well,
ago.
okay. Go ahead.
I have no idea, Blake. How many?
Well, I'm just going to say, I'm assuming a lot of people sold over the last couple of days.
Because of the number 4140.
It's
Fifth
because
number.
of the big 618 retracement.
Yeah,
We've
yeah.
struggled over there the last couple of days. It
Wedge
was a
line.
Coinbase, IPO. What a great day to like see a full-on reversal on the equity markets, right? I mean, think about how many people are feeling that way. So, oh shoot, where am I? Hold on, I'm sorry. I just realized. Oh, lost the chat room here. I need to put that back over where it goes. I mean, it was yesterday. It was like a perfect setup to sell. But how many, and you know, the S&P probably dropped like what, 20 points off those highs, 20, 25 points. And
30.
then right now this morning, it's right back up in their faces. I mean, if you look at the price action now, and by the way, we held the support, right? We held it. So it's right back up in everybody's faces. So anybody that sold yesterday, they got up this morning and they're like, oh man. And I'm not convinced that we're going lower yet. I mean, I know we're at key resistance, but I want to see things happen before I start, you know, getting short risk up here. But I'm just pointing that out because I think there are a lot of people that are right now
looking for a top.
Looking for a top. They're you know, they're selling you know, they're selling risk, and they're just like, oh hey, I'm gonna you know, this has got to be it. And I wouldn't be surprised if we push one more move up and then you know, start to see a little bit of selling. It is very it's very overdone, but it could be more overdone. Don't forget, today we have U.S. retail sales, and I was telling everybody in the chat room today with the retail sales, and by the way, you know, you can get this information right here. With U.S. retail sales, this is data flash, by the way. We're looking for an increase of 5.9%. Month over month. Core retail sales at 5%, and those are some pretty stout readings, and that's what the market is looking for. And quite possibly we could get some decent data today. But do you view decent data as good data, Dale? What do you think?
Well,
Or
that
was
would
good for the market or bad for the market?
might create another pop in yields, which the market
might
like.
create another pop in yields. I'd agree with that, because the market would say, hey, the economy is doing better. And
market
then,
likes Goldilocks, you know.
well, okay,
like
so the
Jerome,
economy's
right?
doing better. So the question that you'd have to ask yourself is that going to be the consumer, you know, roaring back, being strong? You know, is that going to make the Fed or make Powell become hawkish? And that might be the thought of the market, but I doubt it's going to last, because I mean, that guy is the biggest dove on the face of the planet. I thought Bernanke was a dove. And then I thought Yellen was really a dove, but man.
And Powell fooled us initially, right?
He did. I thought he would come
converted
in.
him. They converted him
he
at
would
the
come in and be
Kumbaya.
like, you know,
He
like,
did.
hey, I'm gonna put a spin on the Federal Reserve. I'm gonna come in. What?
He did. Remember, he hiked in December, and we had a crash, and then they had a little powwow. Him and your other two favorites were sitting there holding hands, and he said he made a mistake, and he made the conversion from a hawk to a dove. They gave him Kool-Aid.
I'm almost thinking Trump beat him down to a you know, oblivion.
Oh yeah, he got beat up pretty good there too.
Beat him down so bad that that he probably is like, screw it.
He can't wait to go back to work as a bank teller.
Maybe. So, but he's really, you know, really dovish. So
he went through a conversion.
Hey, so Dimitri said this, and I want to point it out really quick. Dimitri said false breakdowns often lead to breakouts. Yeah, and that's what happened with the Aussie. We had a false breakdown, led to a breakout. But I still think the overall, let's not forget this. All right, and I'm going to go ahead and just say this right now. We are at all-time highs in the equity markets. We have rallied. Let's go to the S&P. We have rallied since the post-COVID lockdown lows. Let's just make sure we know exactly what the numbers are. We have rallied 90%. All right, 15. Wait, I'm looking for the price. There we go. We have rallied 90.82% from the lows. And we could go 100%. We could actually double the market from in 1 year. I mean, we came out we went into lockdown a year and a month ago, something like that. But let's not forget that the Aussie, let's go back to a daily chart here. The Aussie is nowhere near its highs.
Peso's not making new lows either, Blake.
What?
USD MEX not making new lows either.
No, US dollar Mexican pesos in a descending wedge, but it still can't get out of its own way because, you know,
It's still way above the low.
Oh, it's
with the market making a new high.
Yeah, I mean, yeah, and I'll say, yeah, if the S&P goes to 4,300, you know, the dollar MEX is finally going to give way. We'll trade back down towards 1980 or whatever. But I'm just trying to point out here that there are a lot of currencies that have stopped following the equity markets higher, and if the equity markets do, like, let's say today, you know, let's say that, you know, everybody got short, we break down. Yesterday, we rallied to new highs, squeeze out everybody that got short yesterday, squeeze out new highs, get everybody long again, like, oh, we're breaking out again. And then we reverse because the data was good, and the data being that good might actually entice the Fed to be a little bit more hawkish, which, by the way, I still don't believe, but I'm just giving you what the market's explanation of a reversal lower will be later today if it happens. If we have stronger data, the market goes down. What you'll hear on Bloomberg and CNBC is strong data made the market go down because the market thinks that the Fed is going to be more hawkish. I'm just telling you what they're going to tell you if that happens. So, and that's really kind of what I'm looking for. And I'm not excited about doing a whole lot right at this moment in time, but I am very interested to see what happens with cryptocurrency here, because yesterday was a bit of a freaky day. If you own cryptos, if you own, you know, Bitcoin and Ethereum, and you know, we had this rally above these highs, and then, you know, as soon as Coinbase went public, we slammed back down to 62. I actually sold some crypto yesterday. I got in and out kind of quickly, and I'm like, ooh, I don't trade crypto very often. But what I am looking for is, you know, I'm looking for either a move to 60, like Steve said this yesterday, 60 or 2 days ago, 67,000, or, you know, below 58,000, and things would look a little bit different for Bitcoin. And I think if that happens, then we have to really be more concerned with what's happening with risk appetite. So anyway, that's just some thoughts that I've got here. And Stelios, I heard your voice. Good morning. And I'm not sure if
it wasn't me. It was my wife. No, I'm kidding. She probably sounds.
Where would I be?
Man, she sounds hot.
She sounds a lot like me, right?
Have you met Stelios's wife?
Yeah, she's hot. I'm biased, but yes, she is.
Anyway, good morning, Steve. What did you say?
Of course, I'm here. You said.
Oh no, I thought you said something about Stelios's
wife. No,
mouse voice that he was.
Yeah, I know.
I'll be restricted in saying that she cooks beautifully.
I know it's squeaky. It's my voice. Okay, that's what it is.
Well, guys, you know, Coinbase went public yesterday. We have one of the guys in our chat room, Craig. He's actually he was in our chat room years ago, like I want to say 4 or 5 years ago, and he pursued cryptocurrencies in the past, and then he came back to trading, like I want to say a few months ago. And it's good to have him in because I know in our chat room, because I know he stays so up with Bitcoin, but or with cryptocurrencies rather. But Coinbase, you know, they did it was a unique offering, how they went public, because they didn't go public with like in a normal, in a normal sense. So it opened the doors for a little bit of selling. But when you saw Coinbase yesterday come off from the highs and close near its lows, I'm thinking that it got the attention of some of these crypto traders, and it pulled Bitcoin down a little bit. So what are your thoughts here on these cryptocurrencies, guys, and how they're acting?
I don't know is the answer. It's
Not reading too much into it.
They've been bullish for a while, and yesterday's IPO didn't really do anything. So the Bitcoin is still near 63K, Ethereum's unchanged. So yeah, they seem to have got over it. And from what I see, pre-market, Coinbase is going to be up a little bit. So just looks like nothing's changed. I don't know what you think, Steve, but
I would reiterate that I would be very, very careful near these prices with cryptos. Even if I wanted to gain exposure to them, I would wait for a big sell-off at some point. I think in not so distant future. Buying right here, right now, it doesn't make sense. It's just following FOMO. And,
yeah, for sure. Yeah, I'd agree. I would agree with that. Hey, one of the charts I want to talk to you guys about also is, we have this. Where is it? Oh, it's right here. Actually, it's right above where I was at. So, in gold, I'm watching gold pretty carefully because obviously it'll be influenced or will influence the dollar quite a bit. And let me get rid of this really fast and move this. Gold's been developing like this double bottom, and let me actually, there we go. So gold's had a nice, decline all year long. I mean, ever since the beginning of the year, gold's been sliding, and we have seen the dollar pull back. Euro's struggling a little bit at the 120 level as we approach 120. But I'm actually watching gold kind of carefully here because we were having this bear flag. Now it's set up more as a double bottom. We break above 17.6. Everybody should know. Well, in our community should know, above 1765, I'm bullish. But if we break above 1765, perhaps that is the catalyst that actually drives the euro past the 120 level, because the euro has been kind of struggling, as you can see. It's the top of our resistance zone that we've had. Support, resistance overnight held as resistance, but maybe that can break free if gold actually moves, So how do you guys feeling about precious metals at this point? Because they've been pretty quiet, but also, they seem a little, tired of moving lower.
They're definitely not moving higher with risk, right? They've been a little bit hesitant over the past few weeks. And, we're getting to all-time highs. Risk on should be, well, granted, we have higher yields in the US, but they should be following. So they're not following. My view on metals. I always want to be long. So I'm long a little bit of silver and a little bit of gold. But I think we might have another leg lower where I want to add. That's my view.
All right. Yeah. That's some good ideas. Steve, you have any opinions there?
No, I'm not certain yet either if we've seen the low. I'm just certain that this is a corrective phase we're going through. Fundamentally speaking, I've explained again the reasons why I'm convinced this is a short-term corrective move lower and alleviating the overbought conditions of a huge move higher in both gold and silver. I think the market is soon going to wake up to the reality. I mean, Powell keeps repeating it again and again and again and again. The market is going to wake up to the reality that the Fed will allow real rates to become even more negative. And when the market really realizes that, and they realize that their assumption that the Fed is going to increase rates sooner than the Fed says it will, I think that's going to start the next leg higher. Not to mention the fact that everybody, I assume, saw the March deficit, which was $660 billion. We're talking about a monthly deficit, right?
Hey, Steve, just a little heads up.
Yeah, we
have
got
economic data
data
coming out in like just a minute here.
Initial jobless claims 576.
US
retail sales
8.4.
Boom. That's some
Or
strong
core
retail sales right there. So is the market going to view that as good or bad? Look at the dollar yen.
That's a problem. I think more and more good data we get, the more and more the Fed is likely to say, okay, we're going to step off the gas maybe at some point.
That's what I said earlier. I think that,
I agree.
that good data is actually going to be bad for equities. And let's see how equities are responding. So you get the initial pop and then what? You know, and Dale, I know you have an interview coming up. Looks like
I'll keep repeating that everybody is going to be surprised by the fact that the Fed is not willing to do anything about data. And to be honest, the only thing they're right about is that data seem good. They're not good. If we run a trade deficit of 660 billion per month, yeah, I mean, retail sales are going to climb higher with people getting paid for doing nothing. A lot of economic data are going to improve because they're boosted by stimulus. But the question is, if anybody believes that this is sustainable and this leads to economic prosperity, then you should buy everything, because then it seems that we've solved a millennia-long problem. We don't have to work anymore. We don't have to pay taxes. The solution is extremely easy. We print money to eternity, and everybody prospers.
You know, I heard
but economic history has taught us that every single time this has been tried in the past, it ended up really, really badly.
It's like we're borrowing potential future gains and bringing them into the present.
Yes.
At such a fast and dramatic clip that's why we're having euphoric markets, is because 10, 20 years of what would take for these kind of gains all compressed in a short period of time because of the central banks.
Exactly.
All right. Well, I know, Dale, you have an interview.
Yeah, first time guest. I always like to bring in new people and introduce our audience to them, and you know, perhaps they become regulars. So
that's exciting for us today. So have a great interview, and I just want to say thank you all for tuning in today. I appreciate you all and your support, and I know the rest of us here at ForexAnalytix does as well. For those of you that are ForexAnalytix subscribers, Steve Stelios and I will see you in 45 minutes on the Morning Edge. So, and that's when we go through all the analysis for the individual currencies, find out the good support and resistance levels, you know, what levels we're looking for intraday. So I'll see you guys there. Thank you all very much.
It's called the Morning Edge, so when you go in there, you don't get cut up by the markets. Okay, that's the title. Eric,
it's also getting your trading edge too. So yeah.
Okay. Hey, Eric, how are you? So
Can you hear me all right, Dale?
Got you, buddy. Welcome to Face. Very nice to meet you.
Thanks for having me. Appreciate it.
All right. So if you want to share your screen, it's that little green box drop-down menu. See it?
All right.
Yeah, here it comes.
Can you see me?
Okay, got it. Looks like you prepared your PowerPoint.
Yeah, I actually just finished presenting my quarterly, so I figured I'd pull up the slide deck, and wherever the conversation goes, I likely have a slide for it. So. All
right. Well, really great to meet you. I'm always interested in the journey and the road that you took to get from point A to B where you are now. Can you tell us a little bit about, you know, maybe what you were doing before you got into the business and how you got into the business?
Sure. So my quick background, I was involved in markets from a young age, sort of in the family. Studied economics at New York University, took courses in financial crises, money and banking, econometrics. Did kind of odds and ends jobs around the street as I was in school and graduating. Then I jumped over straight to the buy side and worked at a quantitative fund in Midtown called Panorama Partners. And they had some interesting quantitative strategies using long dated options on triple levered ETFs. It's a great experience to work there. However, it was a little bit out of the realm of the economics background that I had. So while I was there, I continued studying economics. Most of my studies were in the long-term impacts of debt deflation, demographics. But being on the buy side, I had an appreciation for the fact that a 3 to 5 year outlook is sort of a unique position to be in, and not a lot of people are able to take that time frame exclusively. Most people need to mark performance on a monthly or quarterly basis. So,
so
I also began.
You use a telescope.
That's right.
Instead of a
microscope. So I began to also augment that work with some of the what I would call business cycle leading indicators. So getting an idea of where the economy is heading over the next couple of quarters rather than just the next 3 to 5 years. Anything shorter than a couple of quarters is sort of your domain with the trading and the charts. I don't really go any shorter than a couple of quarters. But combining the long-term, what I call secular trends, these 3 to 5 year, 10-year trends in the economy with the business cycle indicators giving you a quarter or two heads up of where the economy is heading is a nice balance, which can give you great insight into which asset classes are likely to outperform. And that blend of long-term secular trends and shorter-term business cycle trends was something that I was not seeing while I was at the fund in terms of research that was available. So in 2016, I left that fund to start publishing my own research on that exactly. It's been over 5 years now. It's been going well. So that's sort of how I got to this point now.
And now you produce this letter. You have subscribers and retail and institutional, Eric?
That's right.
Okay. So why don't I start with, something recently that's happened, and I'm curious if you think it's secular or cyclical. And, we've had this shift once yields started to move up from growth to value. And I'm wondering if you think this is just going to be, and a lot of people talking about the inflationary pressures because of what the Fed wants to accomplish, all the printing. Yet there are still very few left of the deflationists out there. So why don't you tell us where you think we're at, Eric? I'm looking forward to your views, hearing your views.
Sure. So I always start with, I am in the long-term disinflation camp, and I always start with this chart of nominal GDP per capita. And the reason I start with this is because this is a nominal series, so we can avoid the debate over whether the CPI is measured accurately or not, because this is a nominal series. And what we see here is, I was writing a couple notes while some of the speakers, forgive me, I don't recall all their names, but why are all the Fed chairmen and chairwomen doves? Why do they come in there and think that something different is going to happen, but they all turn to doves? It's because of this chart right here. No matter what they do, they step in and there's a quarter or two or maybe a year or two of strong growth, but then it immediately turns back down, and they cannot get out of the way of this secular decline in long-term nominal growth. If we flip over to real growth, we see the same thing. Real GDP has been in a continuous decline where over the last 20 years, real GDP per capita has only increased at 0.9%. That's with the reported CPI. So if we agree with the consensus that the CPI is radically mismeasured and inflation is really 3, 4, 5%, then you'd also have to concede that real growth has been negative for basically the last 30 years. Which I don't particularly agree with. I'm more in the camp that the CPI is fairly accurate. And the reason that we have a debate over whether the CPI is accurate is because, as this chart shows, real growth has only been 0.9%. And this is an average. We all know that in the United States, we have a tremendously large wealth gap. So what this means is that there's certain people that are growing at 5, 10, 15%, and then a ton of people that are below zero. And the average is 0.9.
The K.
Exactly. So we are in a situation now where, with such a large wealth gap and such a low rate of real growth, that it's entirely possible that 50, 60% of the population actually has a negative growth rate, which leads people to believe that inflation must be higher than it's reported, when really it's just that the growth is distributed towards one side, and the average is not really representative of a majority of the population anymore. But this is the way it's reported. So the reason that this is coming down is because of two things. Long-term growth is a function, demographics and productivity. Productivity can be proxied via debt. So this is the chart on debt. What this shows is this is the semi-annual change in GDP and the semi-annual change in debt. So what this chart means is that if you go back to the 1960s, if you could see my cursor over here, what this means is that for every dollar of debt that we were taking on, we were generating almost 80 to 90 cents of growth. And this is not just government debt. This is government, business, and household debt. Over time, this has obviously come down quite dramatically to the point now where we're generating 20 to 30 cents of growth per dollar of debt. And our solution to this problem is to try and take on more debt.
More debt.
And exactly.
You know, Eric, I have a demographic question because,
Please.
I used to read things. Harry Dent's one of the guys I've interviewed for a long time, and his bearish argument for real estate, he says, houses don't die, people do, right? And stock market bearish view was because of the demographics. And over the last few years, I've been hearing that there really isn't a demographic problem because the millennials are even as large as the baby boomers who are going to die off. Can you straighten me out on where you think the demographics are here in the U.S.?
Sure. So this chart here, the demographics are a problem. However, the problem in the United States is a lot less bad than the problem in Japan, Europe, United Kingdom, and even China. So as far as the major economies, the U.S. has the best demographics going forward, but it's worse than it was years ago. So with everything in economics, it's always relative to where it's coming from. So if I told you that growth in the was going to be 3%, and that was all the information you had, it'd be tough to make a forecast, a judgment of where it is, because if growth was going from 0 to 3, that's different than if it was going from 10 to 3.
Yeah,
so
like China.
Exactly. So this is the chart here in the United States of the population growth. The population is getting older. We have a age dependency issue where we're going to have a larger cohort in the older population that has to be supported by the younger population. And what's surprising about this chart is we hear a lot of what's going on in the United States now, similar to the Great Depression in 1940s era, where the Fed did yield curve control and we sort of solved our debt problems. And what's missing from that conversation is this piece right here, where we had the largest demographic boom basically the world's ever seen, where population growth went from 0.6% to 2.2%. Now, if we know that growth is a function of population and productivity, right off the bat, we had higher population growth than we do total economic growth at this point. So the idea that we're going to be able to replicate the results from the 1940s with similar policies is not accounting for the fact that population growth has fallen from 2.2% to right here where we are, where the line changes color, is about 0.6. And then the estimates are going to drift lower. But what's interesting is that by the end of the century, we still have positive population growth, whereas Japan currently has negative population growth and Europe has just crossed into negative population growth. So the situation in the United States is getting worse, but it's getting worse at a mild rate, whereas the situation in Japan, Europe, United Kingdom the slope is a little bit sharper. So we are going to have a headwind in terms of economic growth from lower demographics, but that doesn't necessarily mean that asset prices have to follow. That sort of wanders into the realm of monetary policy and things like that, where we're deciding to attempt to solve the situation with tons of excess liquidity. None of that liquidity tends to make it into the real economy. That liquidity tends to slosh around in financial markets and financial assets, which can cause those assets to deviate from their underlying economic fundamentals.
Well, isn't that what we have happening with cryptos and what are those things called? There's all the NFTs.
That's
And
exactly my opinion, is that I'm not too familiar with the ins and outs of the cryptocurrencies, but my general view is that they're mostly a take on excess liquidity in the financial markets, where if we run money supply growth at 20%, a lot of people fear that that's inflationary. Well, we have to look at velocity also, because that's how we get nominal GDP. And despite the fact that we had money supply growth of 20, 30%, nominal GDP didn't budge because it was offset by velocity. And what that velocity tells us is that that money supply is not making its way into the real economy. So this is the velocity. Velocity's fallen to the lowest level in 100 years. Money supply growth is also at the highest level in 100 years. Basically, what that tells us is that nominal GDP is being totally neutralized, but we have a ton of money sloshing around. None of it's sloshing around the real economy. It's all sloshing around the financial economy. And that's where it flows into assets like Bitcoin. And I would call them, I would call real estate and blue chip stocks your primary assets, things that have a legitimate cash flow that you can value at a discount rate. Once those assets sort of get fully priced, the money starts to slosh into secondary and tertiary assets that are a little bit more speculative. And I feel like that's where we're at now.
okay. All right. And this is not a great picture for increased GDP. It seems like I've heard the savings rates at a record high. Is that also part of low velocity of money, that consumers aren't really spending, they're saving, they're paying down debt? Is that part of it?
Yeah. So I'll comment on this, and then I'll make a
Okay.
comment on some of the cyclical trends, which I feel like are also important. So
Okay.
there's a couple things to look at with the savings rate. So there's the personal savings rate, which is what a lot of people look at. But then there's also something called the net national savings rate. And the difference is that the net national savings rate is the combination of government savings or DIS savings if we run a deficit, personal savings, and corporate or business savings. The personal savings rate's very high, but the net national savings rate's negative. So why is that? It's because we're not actually generating any savings out of income. We're generating savings from government DIS savings. So the government is borrowing money, handing it to people, and they're paying down debt or saving it or putting it into stocks and financial assets. So the government DIS savings and the personal savings is totally offset, and that's in the metric of net national savings, which is negative. The difference is in the 1940s. The 1940s had extremely high net national savings, which is how we got out of the debt problem of the Great Depression. We continue to hear the analogies to the 1940s, but the situation is incredibly different in the sense that we had a 25% personal savings rate, but the net national savings rate was about 15%, which means that we were saving out of income. So if you go down to this chart here on the top right, this chart shows federal government transfer payments as a percentage of total spending. So of all the money the government spends, how much goes to transfer payments? In the late 40s, early 50s, about 20% of every dollar the government was spending was going towards transfer payments, which is what we think of Social Security, Medicare, Medicaid, and stimulus checks.
Right.
So 80% of it was actually going into what's called consumption expenditures, which actually is accretive to GDP. That's changed. This has been a secular shift where now 65 to 70% of every dollar the government spends goes towards transfer payments. And that has a very negative impact on growth, because if I borrow money and I send you, Dale, $1, you don't have to spend that dollar. And if I borrowed money, the debt goes up, I send it to you and you save it, debt went up, growth didn't change. So we continue to do this over and over, and our debt burden continues to rise, but people aren't taking that money and spending it into the economy, because there's a concept in economics of, if I get a one-time payment, that's not going to change my outlook very much. I need a permanent shift in my future income curve to really change consumption. and constantly handing one-time checks to people isn't going to make a material shift in my personal income curve out.
Is that part of the argument for like MMT and give universal income?
That is the argument. We could discuss MMT. There's, in my opinion, a lot of misconceptions around what that means,
Okay.
and how it's done. So
I'm going to stop interrupting you, Eric, but maybe because I know you have a lot to say, and we'll do more than one interview. I'm
Sure.
wondering if we could just, besides your all of your fundamental insights, and they really are interesting. What it means to us today, not as traders, but as investors, and is your work saying that we should pare down on risk? You talk about the next 2 to 3 months.
Sure.
I know a lot of people that are cycle guys that think
Yep.
that we could have a pretty good correction in the stock market, and that's a minority opinion right now because people have been crying wolf forever, right?
Right.
So I'm wondering what things that might be actionable that could help people guide them through the shark infested waters over the next quarter or two. What you're seeing.
Okay. Excellent. So
Okay.
as these are the secular trends, and what the secular trends do is they give you a bias of where's the gravitational pull in the economy. But there's also cyclical trends and how the cycle moves. The cycle tends to start with the Fed moving monetary variables like interest rates, and then that impacts cyclical sectors. The most cyclical sectors are manufacturing, housing, and big ticket consumption like appliances, cars, because those are the sectors that are most sensitive. They're typically bought with finance arms and things like that.
Yeah.
And just skipping through all the way to the end here, something that I provide in some of my writings is sort of a dashboard of some of high-level cyclical indicators. We go in pretty deep, but if you just take a look at the cyclical indicators, we're still trending higher on all of the indicators of those sectors. So we shouldn't expect the manufacturing, housing, or durable goods sectors to turn down in the next month or two. There's still some strong cyclical momentum going on underneath the hood. So as long as the economy is trending higher, risk assets tend to perform well. So we hear a lot of, if yields go up, the economy's the stock market's gonna correct. And that may be true. Like we saw that a couple of weeks ago where the bond market got a little disorderly and the market corrected and people were calling for yield curve control. But what we were saying was this is going to be a short-term phenomenon because the economy is accelerating, growth is accelerating. And as long as growth accelerates, risk assets do well. So we've seen 10-year yields go from basically 50 basis points to 150 basis points, and the stock market has, if you take the longer term view, ripped in the face of that. And that's because the underlying trends continue to move higher. So I put together a little dashboard here of what to expect when the economy is accelerating and what to expect when the economy is decelerating. So since the economy is accelerating, based on those cyclical trends, which is counter to the long-term view, but that's sort of what we have to balance. You want to be working with the left side of this chart, which is why value has been outperforming. So when the economy is accelerating, materials, industrials, financials, energy, small caps, international, those are the things that tend to outperform. You don't want to be heavily overweight, long duration. Interest rates tend to rise when the economy is accelerating. You want to be long your industrial commodities and oil. I heard some comments in the beginning that silver acts better than gold, or in some of your charts that silver was acting better than gold. That's totally in line with the fact that the economy has a short-term acceleration. So silver tends to be a little bit more industrial than gold, which is why your industrial commodities will outperform.
Copper. Yeah,
exactly.
Right.
And that's why we've been such strong rallies in there. Now, when our indicators turn back over and we start to see a clear deceleration in the economy, which I would expect in quarters to come, which is where the secular trends come in. The secular trends tell us that the gravitational pull in time will pull these down. We don't have a secular shift where the economy is going to accelerate forever like one of the panelists was saying before that we've solved this debt problem forever. It's not the case. We will turn back down in due course. And when we do, you're going to want to shift over to the right side of this dashboard and get back into your.
What's your best
assets.
guess how long this expansion and central planned economy lasts before we turn down again? Did the Fed buy us 2 years?
No. I don't think it'll be 2 years. I tend to have a rolling outlook over the next couple of months, and I can tell you that we're not going to turn down in the next month or two. But we'll check back in the late summer, August, let's say, and then we'll have a better idea of what the back half of the year is going to look like. But when we do see the indicators turn over is when you will want to shift back to your defensive assets, and when interest rates will start coming back down again, because we have not made the secular low in interest rates. We'll continue to grind to lower lows as long as
negative rates, Eric.
As long as this chart continues to trend lower, interest rates will follow. Negative rates will be determined if the Fed adopts negative rates. We won't be able to be in a situation really for the 10-year rate to go negative if the Fed doesn't want to move the overnight rate negative. But what tends to happen, what happened in Japan and what happened in Europe is conditions weaken, the 10-year rate sort of compresses right on top of the Fed rate. So let's say the 10-year rate is 0, the overnight rate is 0. A flat curve sort of starts to kill the banks. So the Fed's sort of stuck in between a rock and a hard place. And usually they give in and try and steepen the curve by going negative, which as we know, doesn't really work that well. But I think it's a possibility, sure. As long as this chart continues to trend lower, then rates will trend lower. But we do have a cyclical upturn. So
yeah, I mean, there's some people talking about GDP at 8% by the end of the year.
Yeah, and this is a longer presentation. I can send people the slide deck if they're interested. They can shoot me an email. I'll put up my contact information. But we go through all of the different sectors, the housing sector, and we have such a big pop because of this pent up demand that this is a chart of real residential construction spending growing 32% annualized over the last 6 months. Of course, this won't be sustained at these rates, but in the meantime, we have very strong upturns in a lot of these sectors, which I sort of try and pick up in this dashboard and say, hey, when these indicators are all ripping higher, you have to respect the cyclical upturn despite how strong the secular downturn is, and say that, risk assets are going to perform better. You're going to want to work with the left side of the chart.
Let me ask you this, Eric. Were you surprised that the housing market, as far as price appreciation, in many areas of the country surpassed the peaks of 2008?
I was not surprised, because what's interesting is if you price housing in gold terms, it's actually at an all-time low. And this is also similar, not exactly with stocks. And what we see is that a significant portion of the price appreciation has simply been the interest rate effect. So if housing, you have to sort of normalize for the fact that if 30-year fixed rates were 5.5%, and now they're 2.5%, if you standardize for that interest rate effect, home prices haven't gone up all that much, which is consistent with growth. But if you lower the interest rate by 300 basis points, there's going to be a price impact. You're going to be able to carry a more expensive house with the same monthly cost. So when you price
is this
assets
a housing
in gold,
bubble 2.0 developing if we get higher yields, and you're wrong about a move back down to 0.50? What would cause in an environment like this, where they keep talking housing shortage, any kind of real estate problem, do you think?
Well, we'll have a price correction in real estate for sure. As we've seen, so in these indicators here, one of the indicators I have on the right is the 30-year mortgage rate, which will obviously give us some insight into the housing market. It's graphed inverted, so when it's going down, the mortgage rate's going up. So the mortgage rate is going up, and we've seen some cooling in some economic data like new home mortgage applications and things like that. So if mortgage rates do continue to creep up, then we will have a correction in home prices, again, from that interest rate effect. But I don't expect it to be a systemic issue like it was last time, because we're not using as many adjustable rate mortgages, mostly are 30-year fixed. But I completely foresee a correction in risk assets as economic growth continues to trend lower. So yeah, I do expect home prices to come down, as I expect stock prices to come down, but only when we have a renewed cyclical downturn in the economy. I don't expect asset prices to come down while the dashboard looks like this.
Yeah, the question
Okay.
is in nominal or in real terms.
That's a good point. Exactly. So pricing assets in gold gives you a good standardization for the real or nominal terms. What's interesting is if you price the S&P 500 in gold, we haven't made any progress since 1997. And if you try to stack it up with our long-term charts here, it sort of makes sense why that would be the case.
Yep, absolutely.
All right. Well, if you have Steve Volge
So-
saying yes and asking you fundamental economic questions, you've and that he's interested in what you're saying. Wow, you win a medal today, Eric. You win a medal. Go ahead, Steve.
So Eric, in plain English for people, how do you see this phase unfolding down in the future?
So what I would forecast to happen is that the Fed will remain dovish, mainly because they have no other choice.
Exactly.
Eventually, this cyclical upturn that we're experiencing, this pent-up demand, will fade because we have a big shift of people moving from cities to suburbs. That causes a lot of housing demand. That causes a lot of people to purchase new items, and it does give the economy a short-term boost, but that will fade in time. And then the economy will turn back lower again. And the discussion of tightening and tapering will quickly go away. And I foresee that we'll be stuck in a situation similar to Europe and Japan, where the short-term rate is held at zero. The long end of the curve starts to come down towards zero. And then the discussion starts to move into the realm of, do we go negative or do we not? And it may take a correction in asset prices, but it will be a tough situation to avoid some sort of negative interest rate. It may not be legally feasible with the way the Federal Reserve Act is currently
Yeah,
structured.
the vast majority of things central banks do are not legal in any case. I mean,
Exactly. Yeah. So there will be some workaround that they'll have to come up with, whether they charge a fee on deposits or something, but they'll have to manufacture some sort of negative interest rate if they don't want the real interest rates to start going up.
Yeah, although the only part I disagree with is the comparison with Japan and Europe. With the exception of a few countries in Europe, I think that the US would love to become Japan or Europe because I see a lot of issues.
They have trade. They budget surpluses or trade surpluses rather than deficits.
Exactly, and for example, in the case of Japan, the vast majority of the debt is held, by locals, so on and so forth. So I see the US being in a totally different trajectory than becoming Japan. I think that would be a very, very good outcome in comparison to what can happen.
One comment on that is that we're the world's reserve currency. So as a reserve currency, we have to run deficits. You basically can't be a reserve currency without running a deficit because you have to supply the world with your currency. So it would be very difficult situation. I mean, the deficits that we're running are quite large, and it does have a deleterious impact on our growth. But in some ways, it's a positive because we've been able, if we were to use the debt properly, we would be able to finance construction of our country with other people's money. We haven't used that debt properly, and we've tended
you never will because it's not the politically attractive thing to do with debt.
That's correct, but I don't foresee the problem. A lot of the U.S. does run a twin deficit, which is problematic for many emerging market countries, but we're the world's reserve currency, so definitionally.
For how much longer, Eric?
Yeah, that's the thing.
That's not gonna change because there has to be someone who can replace it, and right at this point, there's no one that can come close to replacing
the IMF.
No.
Okay.
No, the U.S.
I'm glad I have
there's
a lot
not
of cash.
there's not a main competitor to the dollar as a
right.
reserve currency.
No
And
digital yuan or anything like
no,
that.
you know,
Okay.
we talk about the problems in the United States, but China doesn't even have an open capital account. So, you know, we talk, if our trade deficit's a problem, they need a rule of law first. The trade deficit
Yeah,
issue
I
is
agree
a
with the
valid,
thing with China, but on the other hand, you know,
it's a valid,
we live in times that there are other solutions than a single currency. And oppositely, one way or another, uh, we've had many world reserve currencies in the past, and none of them stayed as such forever. Why? Because history, you know, makes circles in essence, and what happens is that you get a very prosperous economy doing the right things, and that's why it becomes prosperous. Then its currency is accepted as the world's reserve currency. Of course, you know, the definition of the world has been expanding since that started happening. Of course, it can't expand anymore since, you know, we've explored all Earth and inhabited all Earth. But the thing is that then the economy that has the world reserve currency is taking advantage of that fact and gets derailed in the way it does business and it does things, until in essence that currency loses value and faith is lost in it and something else replaces it. So I really see all the signs of that trajectory in the US and how it handles its economy.
I fully agree with everything you just said. However, at this stage of the game, there's no currency right now that can fulfill all of the roles that the US dollar fulfills. There's still something like 85% of world trade is still conducted in dollars. You'd need to find an example. You know, I'm sympathetic to the idea that the dollar can lose its reserve currency, and it's a fun conversation to have, but we need to propose what's coming. Give me an example of how we're going to introduce a new reserve currency, and then we can start to move
The
down that.
IMF, you know, with their SDRs is kind of like a plan B, isn't it?
I don't think there is any politician honest enough to go back to what would enforce proper economics, which is back to the gold standard, right?
I don't think that's possible. Yeah, I agree.
I think it's possible, but politically, it's
Right.
not
Politically, it'll never happen.
exactly.
Anyway,
Exactly.
Eric, you want to put up your website because we have
Sure.
to wrap here. You
Um,
know what? I'm so glad our paths crossed because you know
so you
what?
can find
It's
me.
gonna be an interesting debate every time you're on with Steve Volk.
Yeah, that'd be great.
So,
So
yeah, all
you
right.
can find me epbmacroresearch.com. You could also find me on Twitter. I have a couple of YouTube videos.
Yeah.
I popped up my website here, epbmacroresearch.com.
Okay.
I have some free research that I post that you can go on and read. I also have a couple premium products. I have a monthly report, which I cover those cyclical indicators only, just cyclical indicators, sort of give you an idea of are we accelerating or decelerating. And then once a quarter, I also give that quarterly presentation, which some of the slides we just ran through. That deck
Do you
that I was
trade,
going
Eric, or invest?
I do invest. Nothing I do is on the short-term time horizon. So I'm mostly in the
Okay.
6 month and beyond camp, but I'll
Okay.
leave the shorter term stuff to you guys. I encourage a lot of people to use my research in conjunction with stuff that you do. Cause you know, I can give you the cyclical trends and the secular trends. I could sort of give you the bias
Yeah.
the bias of, you know,
Yeah.
where we should be. And then if people want to use a more technical approach
Yeah.
to sort of take a tactical entry and exit points, that's
Well,
great.
even though you don't trade, you survived an interview with me and Steve Volge.
that was a good time.
You're now our trading warrior brother.
I love it.
Like it or not, it's a
I love it.
lifetime. It's like being in the mafia.
Thank you very much, mate. Very nice presentation.
No, I
Yeah,
appreciate
very
it.
nice.
Thank you very much.
Yeah, Eric, thank you for your time and sharing your wisdom with our community today. And we will have you back. Okay, bro?
I appreciate that. Thanks for having me on.
All right, everyone.
Have a
That's
great
a
day.
wrap. That's a wrap. And Steve made the interview go long, so he has to write the tagline. And don't forget, don't forget to join Blake and the team on the Morning Edge in 6 minutes, man. So you just have a little time to go to the bathroom if you have commodity
And brush your
kidneys,
teeth.
and brush your teeth and go into the room. All right, guys, that's a wrap. Don't forget, don't just count your pips, count your blessings, and we'll see everyone to wrap the week tomorrow. Thank you, Steve.
Bye-bye.
Great interview. Good job.
Thanks.
All right. See you, Eric.
Bye.